Good morning, participants. I hope you are all able to hear me. And also can see me. If anyone has any audio or video problem, please point out before we start the session today. Okay, apparently you don't have any problem. So you can start today's session. Today we'll be talking about revenue recognition. That is what we are going to discuss in today's session. As you all know, revenue is the most critical aspect for existence of a business. For a business to exist, to survive, to grow, revenue is the most critical aspect, because without revenue, no business can really exist. So it is absolutely important that the point of recognition of revenue is correctly determined. At what point of time we should recognize a revenue, that is very important. The decision as to when and how revenue should be recognized has a significant determination of the net income for the year, that is bottom line. And it is therefore a very critical element in the entire process of preparation of the financial statements. In fact, some of the recent highly publicized financial scandals that caused turmoil in the financial world globally, like Sattam. I do not know how many of you know about this particular Sattam Infotech or Enron. These are caused by financial manipulations resulting from recognizing revenue based on inappropriate accounting policies. So those financial scandals really involved recognition of revenue based on inappropriate accounting policies. So there is a standard in IFRS, there is a specific pronouncement or standard. It's called IS 18, International Accounting Standard 18, which prescribes the requirements for the recognition of revenue in an entity's financial statements. So principal issue in the recognition of revenue is the timing. The main issue regarding recognition of revenue is the timing, that is, at what point of time it should be recognized in the books of accounts. So IS 18 basically deals with this principal issue of recognition of revenue. So today, in this session, we will be talking about the measurement principles for revenue in different scenarios. We will apply the concept to relevant business transactions and determine appropriate amounts. We will try to understand the treatment and accounting requirements for revenue, the disclosure requirements relating to revenue recognition, and also we will try to understand the difference between IFRS and US GAAP so far recognition of revenue is concerned. So this will be today's objectives for our session. So the first question that will come to anyone's mind, how do What is revenue? How do we define revenue? So can anyone respond on that? What is revenue? Can anyone of you please respond on this? What is revenue? Let's see some response coming up. Devale Manish from NG Tank. Income of the company. When very simple words, income of the entity. Okay. What is regarded as income of the entity? Okay. Anybody else like to add something to what Manish has said? Would anyone like to supplement what Manish has told us about revenue? So I'm not getting another response. Okay, another response came up. Samrat Suri from Delhi cannot place. Income of organization in substantial nature. Okay, Vishal from Delhi cannot place again. Sales of the company, Hemant Singh from Delhi South Extent. Revenue is income that a business has from its normal business activities. States annual income for which public expenses are made. That is from Nitiparna. Okay. So I have got several responses. Mayank from Delhi cannot place again. Income from operating activities, or you can also say sales of the company. Okay. All of you are correct to some extent. Okay. So let's see. What is the definition of revenue? As per IS 18. Mayank says income from operating activities. Okay, fine. This is as per IS 18. What is meant by revenue? It is the gross inflow of economic benefits arising in the course of ordinary activities of the business. So it is basically gross inflow, not net inflow. Net inflow of economic benefits will be profit. It is the gross inflow of economic benefits arising in the course of ordinary activities. This is one definition of revenue. Further supplemented by it results in increase in equity other than the contribution from equity participants. Right? Got some more responses in the meanwhile from Mayank and Subhas Dogra. Okay. Thanks to all of you for your responses. So, as per IS 18, which we are going to discuss today, International Accounting Standard 18, revenue is the gross inflow of economic benefits arising in the course of ordinary activity. So, a few points to be remembered. It is the gross. We are not talking of net inflow of economic benefits. And similarly, arising in the course of ordinary activities. So, not in the course of something which is not related to the ordinary activities of the business. If there is an economic benefit, inflow of economic benefit, that may not be treated as revenue. So, it is the gross inflow of economic benefits arising in the course of ordinary activities. Secondly, it results in increase in equity other than the contributions from equity participants. So the increase in equity can arise from two reasons. One is from revenue. In fact, three reasons. Revenue, other economic benefits arising in the course of activities which are not ordinary, cannot be really called ordinary business activities. And third is equity contribution or contribution made by the equity participants. So revenue results in increase in equity other than the contributions from equity participants. Remember one thing, when you talk about revenue, it refers only to those amounts received or receivable by an entity on its own account. So amounts received or receivable for the accounts of others is liability and not equity. Like say example is, you go to a store and buy some product, some electronic product or something you buy from a store. Now when the store sells you the product, they gives you a invoice. The invoice will contain the cost of that product which you have purchased plus VAT, value added tax. Now what is revenue part? In this invoice, the cost of the product is only the revenue for the store, not the VAT. Because VAT is collected and it is owed to the government. VAT actually will be paid to the government in the store. So the store which is receiving the amount from US, the cost of the product that is sold, that is on account of the store's own business. But the VAT that is collected, VAT that is charged on the product price, that is collected on behalf of the government. That money is owed to the government and the store has to pay to the government. The business will have to pay this VAT, pass on the VAT to the government. So that's not revenue. So revenue is basically amounts received or receivable for the accounts by the entity on its own account. Any amount received or receivable on account of others is a liability and not equity, not revenue. Like VAT collected is owed to the government. Now the requirement of IS 18 are to be applied in accounting for revenue arising from sales of goods. So it can be applied when a business is engaged in selling of goods or rendering of services, service industry, like a restaurant, like a hotel, internet service provider. So they provide services, utility service provider. So revenue requirements of IS 18 are to be applied in accounting for revenue arising from sale of goods, rendering of services, even the use by others of the entity's assets, thus yielding interest, royalties or dividends. That is also revenue. If the entity's assets are used by somebody else, or the entity will charge for the use of the assets in the form of interest or royalties or dividends. So those are also revenues. The standard doesn't deal with, IS 18 doesn't deal with revenues arising from the following items which are dealt with by other standards. Please understand, IS 18 doesn't cover all kinds of revenue. IS 18 mainly covers revenue arising from sale of goods, rendering of services, and used by others of the entity's assets, thus yielding interest, royalty or dividends. But IS 18 doesn't deal with revenue arising from some other items which are dealt with by other accounting standards, like leases. A company which is in leasing business, a leasing company, they also generate revenue from leasing, but that is dealt with under a separate standard called IS 17. Dividends from investment accounted under the equity method, that is dealt with under IS 28. There is a separate standard for accounting treatment of dividends from investment which are accounted under the equity method. Insurance contract, that is dealt with a separate accounting standard called IFRS 4. Changes in fair value of financial instruments, that is again, that could be a revenue also, but that is dealt with under IS 39, a separate standard. Changes in the value of the current assets, initial recognition and changes in value of biological assets, which is dealt with under IS 41. Change in values of current assets dealt with under IS 2, which we discussed in the last session. Initial recognition of agricultural produce, again dealt with under IS 41. Extraction of minerals, again dealt with some other standard. Now, these other standards which are dealing with leases or fair value of financial instruments, some of these standards will be discussed during this course. Some of the standards will not be discussed. That is not within the scope of this course. Today we are only going to discuss IS 18, which basically deals with revenue arising from sale of goods, rendering of services, and used by others of the entity's assets, thus yielding interest, royalties or dividends. So, having understood the concept of revenue, what is revenue, now we'll talk about how is revenue measured. How to measure the revenue. So, measurement of revenue Revenue is measured at the fair value of the consideration received or receivable. It is measured at the fair value of the consideration received or receivable from sale of goods or from rendering of services or from use of entities' assets by other entities. Okay, that is fair value of the consideration received or receivable. It is adjusted for the trade discounts and volume rebates, because sometimes when company sells its products, they may provide trade discounts or volume rebates to the buyer. Company has a certain price for a product, but if you want to buy it in large quantity, they may give you volume discount. Or supposing the company sometimes finds to offer trade discounts, buy one, get one free, things like that. Fair value is a very important concept. Fair value means the value that will be paid for that product or service in an arm's length transaction. That means the buyer and the seller at arm's length, they are not related to each other, so it's basically fair value means, generally fair value means market value. Generally, fair value is a very important concept. What is fair value? Now, fair value is basically at an arm's length transaction, what is paid, what is to be paid is called fair value. Now, supposing a store owner it can happen. The store owner, a friend of his comes and he sells the goods at a very reduced price. But that is not a fair value. That is not a fair value of the product. Because that is not an arm's length transaction, because it is sales to a relative or somebody, that is not an arm's length transaction. Arm's length transaction means where the sellers and the buyers are not related. So basically there is, it's a kind of a transaction where the sellers and the buyers have no, I would say, love or hate for each other, okay, that kind of a thing, where there is no special treatment being given, arm's length transaction. So supposing a company sells goods to its subsidiary, a company produces certain goods and sells it to the subsidiary. Now company can say, even if I am selling the goods at a higher price to others, I charge lower price to the subsidiary. That is not a arm's length transaction. So fair value is something, a very subjective concept, fair value. Okay. But generally market value we consider as fair value, because market, whatever product, whatever it gets in the market, because market consists of large number of players. So what is the market price is something indicative of the fair value of the consideration. So revenue is measured at the fair value. We'll come to the fair value. We'll discuss about fair value more afterwards. Revenue is measured at the fair value of the consideration received or receivable. It is adjusted for trade discounts and volume rebates. Sometimes trade discounts are given. Like a car manufacturer may find that some model of car is not selling, so they offer a discount. Somebody who wants to purchase the car, he will be offered a discount. Although the car is priced at, let's say, 4 lakhs, you have a cashback or you have a discount offered on the car, so that you can get it at a lower price. Or sometimes stores will start selling buy 2 get 1 free or buy 1 get 1 free. These are all basically discounts. So there could be trade discounts, there could be volume rebates. If you buy more quantity, more number of units, the price can be reduced. So a volume rebate is given. If these are not there, supposing no trade discounts are there or volume rebates have been given, then the fair value of goods or services given up is taken as the revenue. Remember, sale tax or VAT collected on behalf of the government, or basically government actually, is excluded from the revenue. That is not part of the revenue because that is received on account of others. That is not on account of the business itself. So that's why sale tax or VAT collected on behalf of others is excluded from determination of revenue. Now the fair value, somebody is asking what is fair value. The amount for which an asset can be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. That is what is the definition of fair value. The amount for which an asset can be exchanged or a liability settled between knowledgeable and willing parties. Two things are important. The parties should be knowledgeable. They should have knowledge about the product they are buying or selling, or the transaction they are doing. They should be willing, both of them, in an arm's length transaction. That means the parties don't, arm's length transaction means basically parties don't know each other, they have no relationship. Okay, in that sense. So, two things. The amount for which an asset can be exchanged between knowledgeable, willing parties in arm's length transaction, that is called fair value. Supposing somebody is able to sell some goods to another person. The other person is not very knowledgeable about the product he is buying. Not very knowledgeable, he doesn't know at what price the goods sell in the market and all that. He is an ignorant person basically. The price at which the goods are sold cannot be considered as a fair value because the buyer may charge a higher amount to the seller than at the price he is charging to others. So we cannot consider that as a fair value. Okay. So people should be knowledgeable. The two parties must be knowledgeable who are exchanging goods for money. They should be willing, second thing. And third is, the transaction must be arm's length transaction. That means the two parties don't have any, I would say, special kind of interest. It's a normal kind of arm's length transaction means the transaction you are doing, the people are basically at arm's length, that is, they are not very close. In no sense they are close really. Like as I give you the example, when a company sells goods to its subsidiary or associate company, it may not be considered as an arm's length transaction because there is a relationship between the parent company and the subsidiary. So parent company may charge a lower price to the subsidiary compared to what they are charging to others. So that is what arm's length transaction. So that is what is fair value. Now fair value is, as I told you, it's a concept. It's a very subjective concept. So what is what is fair value? It is sometimes very difficult to determine. So normally what we take as fair value is the market value, normal market value. That is considered as fair value. Because in the market when you are selling goods, it is assumed that the people who are buying are knowledgeable. They have come to you for buying those things as a willing party. And thirdly, the transaction between the buyer and the seller is an arm's length transaction because buyer and seller have no special kind of relationship between them. So what is sold in the market price can be considered as representative of the fair value. So revenue has to be measured at fair value of consideration received. Thus, if the goods are sold and consideration received is in form of service, sometime it happens. So market value is a good measure of the fair value. That's what I'm telling you. Market value of a product is a good measure of the fair value. That much I'm telling you, because if you look at transactions taking place in the market, they are normally between parties who are knowledgeable, between parties who are willing and who are at arm's length. So market transaction basically meets all the definition of fair value. That's why the market value is normally taken as the fair value. Is that clear? Because the three criteria for fair value, one is the parties must be knowledgeable, parties must be willing, and they should be at arm's length. That means not specially related to each other. If these three conditions are met, then we can say the value for which the exchange, the value at which the exchange took place is the fair value. So something is sold in the market, like say stock price. I'm just giving an example. Price of a stock in the market, in the stock exchange. Now here, the person selling doesn't know the person buying doesn't know the person selling. They are doing the transaction to the exchange. Generally, people who are coming to the stock exchange for buying stocks or selling stocks, they are knowledgeable about stock market. They are knowledgeable about stocks. And they come willingly. Nobody forced them to sell, nobody forced them to buy. So if you look at a transaction in a stock exchange, it meets all the criteria which we apply for fair value. That means knowledgeable parties, willing parties, and at arm's length transaction. So when you are placing an order in a broker for buying a particular stock, you are knowledgeable. It is assumed that you are knowledgeable about stock market of that particular stock. You have an interest in buying that stock. So that's why you have placed the order. Secondly, you are willing, nobody has forced you to do it. You have done it in your own. And thirdly, when you place the order through a broker, you do not know who is the party going to sell. Who is the other person, investor, going to sell the stock to you. So you are at arm's length. So you even don't know the name of the person who is selling you the stock, because the transaction is going to stock exchange. Your broker will only place the order on the exchange. The seller's broker will also place an order on the exchange. And these two orders will be matched by the system. Okay, so the seller neither knows the buyer doesn't know the seller. So there is it's a totally arm's length transaction. So that's why when you talk about fair value of a stock is its market value. Stock market value. Whatever stock market price is there for the stock is its fair value. That is the concept of fair value. But if one of the two parties involved in a transaction is not so knowledgeable, is totally ignorant, is not really willing, or doing it unwillingly, or the two parties have a special kind of relationship, then it may not be considered as fair. That is my point. So again, as I told you, it's a concept, and if we normally market price is considered as fair value, because that is the best indicator of fair value. Now, in fact, now I move from fair value to something else. Revenue has to be measured at fair value of the consideration received. Sometimes goods are sold and the consideration received could be in the form of services. Somebody is selling goods and getting services in exchange of it. You may not get money. It's possible. Okay. So some entity is selling some goods, and in exchange for those goods, the buyer of the goods is providing services to the entity. If the goods are sold and consideration received is in form of service, the fair value of that service in a competitive market is the revenue amount for the seller. So supposing a company sells some products, the contract between the buyer and the seller is that the seller will sell the products, the buyer will provide certain services to the seller. Now how do you arrive at the fair value of the consideration? So you have to take the fair value of the services rendered by the buyer of the goods in a competitive market. You have to estimate what is the fair value of that services which is rendered by the buyer in a competitive market. And that should be taken as the consideration for the seller, or revenue for the seller. So when exchange of goods and services are made, the revenue for sale of goods should be taken as the fair value of the service rendered in a competitive market. It has to be determined, it has to be estimated. If you have an idea about how much the service costs in a competitive market, then you can measure it much more easier. Okay. So that is the concept of measurement of revenue. Any other question? So when exchange of goods or service takes place, when goods or services are swapped, that means one party provides goods, sells goods, the other party also provides goods. Sometimes it is called something called bartering, you know that. So one entity sells goods, the other entity also pays for the goods in terms of some other goods. That is called bartering. Or similarly services. One party provides a service, the buyer renders service, the seller also renders service. So when goods or services are swapped, the revenue is only generated if the exchange is for dissimilar goods or services. So you are selling one type of goods and instead you are getting another type of goods, different type of goods. Then revenue is generated. But if you are getting the similar type of goods, then revenue cannot be considered to be generated. Similarly, one service provider is providing service to another service provider and getting a different kind of service from the other service provider, then revenue is generated. But if the similar services are exchanged, then it is not revenue generation. So exchange of goods, in the matter of exchange of goods or services, When goods or services are swapped, the revenue is only generated if the exchange is for dissimilar goods or services. And fourthly, another important thing regarding measurement of revenue is deferred consideration. Deferred consideration means the consideration will be paid at a later point of time. You are selling goods and the consideration you are going to receive maybe after 6 months. So the payment for the goods will be made after 6 months. This is called deferred consideration. Consideration is deferred. Deferment of consideration. So an entity, a company sells good and the buyer of the goods will pay, let's say after 6 months or 1 year. So if consideration is deferred, the difference between the fair value and nominal value of consideration is recognized as the interest revenue. So how do you get the fair value? We can discount the future receipt at an imputed interest rate. So you can take the discounted value of the future receipt. Supposing company A sells goods, we'll see some examples on that. Company A sells goods to company B. The company, when the goods are sold, it is agreed that the company B will pay after 6 months. Imputed means implied, some imputed interest rate we have to use. We'll see some examples when we come to this. Okay. So just listen to it carefully. Now, company A sells goods to company B and company B is going to pay for the goods after 6 months. They are going to pay 5 lakhs after 6 months. Now, what is the fair value? If the rate of interest is 10%, if the company A now calculates that since we are not getting the funds immediately, we may have to borrow the funds for running our business, we may have to borrow the funds for 6 months. So we have to pay some interest to the bank. 3. I am selling goods today but I am not getting paid today. I am going to be paid after 6 months. Now during this period of 6 months, I need this money to run my business, so I have to borrow the money from the bank to run my business. After 6 months when the buyer pays me the money, then I can repay that borrowing. But in the meantime, to run my business, I have to borrow the money from the bank. So I have to pay some interest to the bank. That could be the imputed interest. Okay. So supposing A has sold goods to B and B is going to pay after 6 months, say 5 lakhs of rupees. But A has to borrow money from the bank to run his business, so he's paying 10% interest to the bank. So what is the discounted value of that 5 lakhs at a rate of interest of 10%? That you have to calculate. That will be the fair value. That will be the fair value of the goods sold. Now the difference between the nominal value is how much? That's the discounted value of that 5 lakhs discounted at 10% rate for 6 months is 4,80,000. That is the fair value of that goods sold. The difference between 5 lakh and 4,80,000 will be recognized as interest rate. So in case of deferred consideration, not only we will consider the revenue from the sale of goods, but we have to also take into account interest revenue, which will be the difference between the discounted value of the future receipt at the imputed interest rate and the nominal value of the consideration to be received. That is basically, that difference will be treated as a interest revenue, not as a revenue from sale of goods. Understand? So we'll see some example. So understand, try to understand this example because I have already given a small example to it, but let's look at a example given in your system. S Limited sold goods to B Limited on 1st of January 2015 for a price of 1.17 million. Under the agreement, B Limited will make the payment on 31st December 2016. That means after 2 years. Goods, that can happen, particularly for capital goods, etc. Payment can be made after a longer period of time. So, S Limited is the seller of the goods, B Limited is the buyer. Sales have been made on 1st of January 2015. The price agreed is 1.7 million, which will be paid by B Limited to S Limited on 31st December 2016, that is after 2 years. The imputed interest rate is 8.2%. Now what I have tried to explain to you what is imputed interest rate. Now S Limited has some goods, but they are going to be paid after 2 years. So during these 2 years, S Limited will require to borrow money from the bank to run its business, because the 1.17 million will be received after 2 years. During this period of time, S Limited cannot stop its business. So they have to borrow money from the bank, so they may have to pay interest to the bank for the borrowed funds. So that could be the imputed interest rate. The imputed interest rate is 8.2%. What amounts will be recognized in FY 2015 and 2016? So what revenues will be recognized? What are the revenues that will be recognized in the financial year 2015 and 2016? The solution is something like that. We have to calculate the discounted value of that 1.17 million discounted over a period of 2 years using the imputed interest rate of 8.2%. So the discounted value of 1.17 million over a period of 2 years at the rate of interest of 8.2% will be 1.17 divided by 1.082 square, because it is 2 years period. So that comes to 1 million. That will be the revenue that will be recognized on 1st of January 2015. On 31st December 2015, that is the date the sale is made, 1 million will be recognized as revenue, which is basically the fair value or the discounted value of 1.17 million to be received after 2 years using the imputed interest rate of 8.2%. That will be the revenue recognized in the books of accounts of S Limited. On 31st December 2015, the finance income of 0.82 million on 1 million, they have earned interest of 8.2%. So this money, as if they have lent this money to B Limited, as if they have lent 1 million to B Limited, and at 8.2%, the finance income will be 0.82 million, which is 1 million, 8.2% of 1 million. That will be recognized as finance income, interest revenue. 1 million will be recognized on 1st of January 2015 as sales revenue arising from sale of goods. On 31st December 2015, in the books of S Limited, they will recognize interest revenue of 0.82 million for the year 2015. And in the next year, on 31st December 2016, when the payment is to be received from B Limited, finance income of 0.88 million, which is actually 8.2% of 1 million and 0.82 million, 1.82 million, that is the finance income for the year 2016. So the interest revenue for the year 31st December 2016 will be 0.88 million. This is the way the revenue will be recognized. So revenue will be recognized from sale of goods, revenue will be recognized from interest revenue also has to be recognized separately in case of deferred consideration. If it is not a deferred consideration, if the consideration is paid immediately, there is no question of recognizing interest revenue. But if there is a deferred consideration situation, then interest revenue has to be separately calculated and recognized at the appropriate point of time. The entire interest revenue of 1.17 million cannot be recognized on 31st December 2015. 1 million means 10 lakhs, yes, right. 1 followed by 6 zeros. Okay. So this is the case of the deferred consideration. So how revenue is recognized in a deferred consideration situation. Okay. We'll look at another example, that is, let's look at the second example. S Limited has arrangement with customer B Limited that in any 12 months period. Now let's look at this example. This example is also a good example. The agreement between S Limited and the customer B Limited is that in any 12-month period ending 31st December, that means from 1st January to 31st December, that is the period, if B purchases goods of value exceeding 2.4 million, there will be a retrospective bulk discount of 1%. That discount is normally not given. That bulk discount or volume discount will be given once purchase of goods by B exceeds 2.4 million, then retrospectively a ball discount of 1% will be given, and there is VAT of 5%. Now, S Limited's year end is on 30th September and it has made sales to B Limited of 2.25 million from 1st January to 30th September. How much revenue A Limited should recognize for the year ended 30th September? That's the question. Remember, the arrangement between the S Limited and B Limited is that in a period of 12 months starting from 1st January, if the purchase by B exceeds 2.4 million, purchase of goods by B from S Limited exceeds 2.4 million, then a bulk discount of 1% has to be given on the entire sales, retrospectively. Okay. Now, as on 30th September, B has purchased of 2.25 million from 1st January to 30th September, so still 3 months are left. Now, S Limited is closing its book on 30th September. How much revenue should it have for this period? Now, we have to consider here the annualized sales on a pro rata basis. If 2.25 million is the sales made to be limited during 9-month period, how much sales on pro rata basis will be made to be limited? Will be 2.25 by 9 into 12. So the expected sales on pro rata basis that will be made to be limited during the period 1st January to 31st December will be, because already 2.25 million has been sold to be limited. So the annualized sales on pro rata for this year will be 2.25 divided by 9. 9 months sale is 2.25 into 12. So 12 months sale will be 3 million. So if it is a sales of 3 million, then as per the agreement, B Limited is entitled to what? A bulk discount at volume discount of 1%, which will apply retrospectively. It has to be given on the entire sales of 3 million. Thus, A Limited should consider the retrospective bulk discount while recognizing the revenue of 2.25 million in its book. As the sales to B Limited is likely to exceed or will be in the region of 3 million for the period from 1st January to 30th January, the bulk discount has to be provided. So B Limited, taking a conservative, again, this is when you are doing the revenue recognition, you have to be prudent. I do not exactly know when is the second cycle test, because then I have to check your session plan that I have not checked. I can tell you only on next Monday. Okay? But I don't think it is not in this week, that I am sure. I checked your this week schedule, it is not there this week, as I remember. Retrospective means it will apply from 1st January. Supposing, just trying to understand, from 1st January, B Limited is making purchases. 10th of what? 10th means expect some time off. 10th means actually next Saturday, like this. Devale, Manish has already checked it, it's 10th, so you don't have to worry. Now somebody wants to know, Hemant wants to know retrospective, so I am just explaining what is retrospective. Retrospective is supposing B Limited is making purchase. So at one point of time, it has made purchase of 2.25 million, let's say till 30th September. Now supposing it orders it buys another 50,000 worth of goods in October. How much sales will be generated till October? 2.75 million. Now on this 2.75 million, on the entire 2.75 million, they will get a trade discount, volume discount of 1%. So the volume discount will apply retrospectively from the first sale made to them in January. It will also apply on the sales which are made earlier. That is not a part of the revenue. As I told you, VAT is collected on behalf of the government. So the mention of the VAT is actually just to basically it's information which you don't require. Sometimes in a question the information that is not required is also given just to confuse you or just to raise doubts in your mind whether you should use the information or not. So VAT is not ever a part of the revenue calculation, because VAT is collected on behalf of the government, it is collected on account of others, which I mentioned earlier. I'll go back to the slide. Please remember, sale tax or VAT collected on behalf of others is excluded from the revenue. Is that clear, Hemant? So here, although there is a mention of 5% VAT, we don't have to bother about VAT because VAT is not included in the revenue calculation. Is that clear? Information is there, that doesn't mean you have to use all the information. Okay. Now, retrospective, I hope you have understood, it will apply to all the sales which have been made earlier. That is retrospective. So, whatever sales, supposing at some point of time after September, the sales becomes exceeds 2.4 million, then that 1% discount will apply on all the sales which are made till that time from 1st January. And it will also apply on all the sales to be made subsequently. That is what is retrospective. If it is prospective, then it will apply only on subsequent sales. Retrospective means it will apply on the sales made in the past. So, considering that 2.25 million has been the sales made to B or purchases made by B till 30th September, the annualized pro rata sales to B would be in the region of 3 million, so B will be entitled to that volume discount of 1%. So, while recognizing revenue at the time of closing of S Limited books on 30th September, they have to consider that retrospective bulk discount which will apply on this 2.25 million also. So how much revenue they should recognize? 2.25 million reduced by 1%, that bulk discount to be given on this 2.25 million of sales. So it will be 2.25 minus 1% of 2.25 is 0.0225. So revenue will be 22,27,500. That much revenue should be recognized, because that 1% bulk discount will apply. Up to September, they have made sales of 2.25 million, so the annualized sales comes to more than 2.4 million to be limited, so the bulk discount will apply, and it will apply on the sales of 2.25 million also. Retrospectively it applies. So 1% of 2.25 has to be reduced from the sales figure, that is 2.25 million. So 2.25 minus 0.225, it comes to, revenue will come to 2.275 or 22,27,500. Is that clear? Now we will come to revenue recognition criteria for sale of goods. So when do we recognize revenue? Sale of goods have been made, but what criteria should apply that goods have been sold and we can recognize the revenue? So what are the important criteria? Conditions, 5 conditions that must be satisfied to recognize the revenue. There are 5 conditions we have to think about always. All these 5 conditions must be satisfied to recognize any revenue. Number 1, significant risk and reverse of ownership are transferred to the buyer. So there are certain risk and reverse. When you own something, certain products, there are risk and also reverse. The significant risk and reverse of the ownership have been transferred to the buyer. That must have happened. No effective control of the goods sold is retained by the seller. Seller doesn't have any effective control over the goods sold. Third thing, the amount of revenue can be reliably measured. It is possible to reliably measure the amount of revenue. Fourthly, it is probable that economic benefits associated with the transaction will be derived. And fifth is a cost incurred in respect of a transaction also can be identified and reliably measured. These 5 criteria must be met for recognition of revenue. These are 5 conditions which must be there, must be fulfilled for recognition of revenue. So we'll discuss some of these conditions. All the 5 conditions should be satisfied to recognize the revenue. Revenue, remember the last point, a cost incurred in respect of a transaction can be identified and reliably measured. Revenue cannot be recognized when the related cost cannot be measured reliably. In such case, if the related cost cannot be measured reliably, then in such case the sale proceeds should be recognized as a liability and not sales, not as revenue. The amount received from the buyer will be recognized as a liability since you have not been able to determine the related cost reliability. It will be liability and it will not be taken as sales. Now all the 5 points have to be satisfied for recognizing the revenue. Transfer of risk and reverse of ownership is critical substance of key determinant. For example, if goods are sold but the receivables will be collected only if the buyer is able to sell them ahead. Like consignment sale. Consignment sale, the goods are sold to the consignor sells the good to the consigned. But here the receivables will be collected only when the consignee is able to sell the goods. When sales are made on consignment basis, the consignors makes the sale to the consignee. Consignee will pay the consignor only after being able to sell the goods. He may even return the goods if he is not able to sell. So that means the significant risk and reward are retained by the original seller. When you make a consignment sales, the consignor retains the significant risk of ownership and reward. That remains with the consignor. So it is not transferred to the buyer or the consignor. So consignment sales, when consignment is made, the consignor will not recognize that as a revenue because the significant risk and reward of ownership has not been transferred to the consignor. The sale will not be recognized. A revenue from the sale will not be recognized. Okay. The point of time at which significant risk and rewards of ownership transfer to the buyer requires very careful consideration. You have to know at which point of time the significant risk and rewards of ownership gets transferred to the buyer. That will be the time when the revenue should be determined and it should be carefully considered. So you have to examine the circumstances surrounding the transaction. So each transaction you have to know the circumstances and then you can understand the timing when the significant risk and rewards of ownership is transferred from the seller to the buyer. So it will depend on the circumstances relating to the transaction. Generally the transfer of significant risk and rewards of ownership takes place when title passes. When the title passes on to from the buyer to the seller, significant risk and rewards of ownership takes place. Like say, asking a question. You are buying a property. You have already paid money to the builder. You have paid the full consideration to the builder. Will builder be able to recognize it as a revenue at that point of time? When should builder recognize the revenue from the sale of property? At what point of time should recognize it? What is the timing when the significant risk and rewards of ownership have been passed from the seller to the buyer? So when the property title passes from the seller to the buyer, that means when the property gets registered. Property title passes from seller to the buyer when it is registered with the register of properties. So when the registration takes place, the title passes from seller to the buyer. So at this point of time, the seller, that is the builder, will be able to recognize the revenue from the seller. That is not before. Although he may have paid the money, even he has been given the possession. But till the time the title passes from the seller to the buyer through an act of what is called registration of the sales deed. The title passes to registration of the sales deed. So till that time, we will consider the revenue has not been earned or the revenue cannot be recognized. That is the point I am trying to make. Or it can be when the buyer, sometimes there can not be explicit passing of title when the buyer receives possession of the goods. Okay. However, in some circumstances, the transfer of risk and rewards of ownership doesn't coincide with the transfer of legal title or the passing of possession. Okay, we'll have a short break at this point of time and then we'll continue with this revenue recognition. Welcome back after the break. If legal title is passed, sometimes the legal title may be passed, but risk and rewards are retained. No sale should be recognized. Example is consignment sale. Goods sent on approval basis. The legal title will be passed. But risk and rewards are still with the seller, because goods may not be approved or the consignee may not be able to sell the goods and still return. So the significant risk and rewards of ownership is still retained with the seller. In that case, revenue should not be recognized. If installation is a significant part of a contract and it remains incomplete, somebody is supplying plant, selling some machineries which have to be installed, and installation is a significant part of that contract, because the contract means selling of the machinery and installing the machinery at the buyer's factory. So it remains incomplete. Then there is an obligation or there is an obligation for unsatisfactory performance that is not covered by a normal warranty. So if installation remains incomplete when installation is a significant part of the contract, or there is some obligation for unsatisfactory performance which is not part of the normal warranty. If these are there, then revenue may not be recognized, although title may have been passed from the seller to the buyer, because the risk is still there. So here, transfer of legal title may have happened, which is an evidence, normally evidence of transfer of risk and rewards of ownership, but that is not a conclusive one. So transfer of title doesn't really mean that the risk and rewards of ownership have been transferred from the seller to the buyer. In some cases, like consignment, goods sent on approval, uncompleted performance on contract, this risk and rewards of ownership still retained with the seller, and so revenue should not be recognized. Now we'll look at specific cases. Sale of goods. On specific cases we'll look at bill on hold sales. Here the delivery is delayed at a buyer's request, but the buyer takes title and accepts the billing. So the bill on hold sales is basically a kind of a sale where the delivery is delayed at the buyer's request. Buyer wants the delivery to be made at his featured date, but the buyer has taken the title and accepts the billing also. Here revenue will be recognized when the buyer takes the title and accepts the billing, although delivery may be made subsequently. Consignment sales. Revenue is recognized by the shipper when goods are sold by the recipient to a third party. When the consignee is able to sell the goods to a third party, then only revenue will be recognized by the consignor. As long as the goods are not being sold or the consignee is not able to sell the goods, no revenue should be recognized. Cash on delivery. Sometimes nowadays people are purchasing goods from Amazon or some other e-commerce sites on cash on delivery terms. So here revenue will be recognized when the delivery is made and cash is received by the seller or its agent. Till the time the goods are delivered to the buyer and the cash is paid by the buyer, no revenue should be recognized. Advance payment for delivery of goods. Revenue will be recognized although payment has been received from the buyer in advance. Revenue should be recognized when the goods are actually delivered to the buyer, not at the point of time when the payments have been received. Payment have been received in advance, but the goods have not yet been delivered to the buyer. So in that case, revenue should be recognized only when the goods are delivered to the buyer. Because in all cases, we have to see whether the significant risk of ownership is retained by the seller or not. Basically, if the seller retains a significant risk of ownership, the transaction is not regarded as a sale for the purpose of recognizing revenue. A seller may retain significant risk of ownership which may be manifested in numerous ways. We'll see an exercise to show circumstances wherein the seller retains significant risk of ownership. In subsequent exercise we'll see that. Other specific cases, sale and repurchase agreement. Sale and repurchase agreement is an agreement where a seller may repurchase the goods at some later date by an explicit agreement or call option to repurchase. So there is an agreement between the seller and the buyer. Seller is selling some goods to the buyer. He may repurchase the goods at some later date. There is an agreement that he may buy back the goods at a later date from the buyer, or he has a call option to repurchase. That means he can ask the buyer to sell back the goods to him. In this agreement, in such kind of agreement, the revenue is recognized according to the substance of the transaction. Somebody wants the last slide, so I'm going back to the last slide. I'm just interrupting what I'm saying at this point of time. Let's go back to the last slide, because someone is not finished with the earlier slide. Pratibha, let me know when you are done with the last slide. Consignment sales is the sales. I'm responding to a question from Shivam from Delhi South Extension. He is asking about consignment sales. So I'm trying to explain it to all of you. Consignment sales is a sales where the person selling sends the goods to the consignee. Okay. The consignee will sell the goods to third party. Okay. Understanding is that A sends goods to B and B will sell those goods to other people. Okay. So that is the agreement. So this is called consignment sales. If B is not able to sell the goods to third parties, then he will return the goods to A. Like I am giving an example, consignment sales. Banks sell gold coins. Many of the banks sell gold coins. Now these gold coins are actually manufactured by refiners, gold refining companies. These are mostly companies in Switzerland. Okay, so they actually refine gold, and the refined gold is converted into gold coins or gold biscuits. And this gold refiners, they are sending these gold coins to, let's say, Axis Bank. So Axis Bank will hold the gold coins. So the consignor is the gold refining company. The consignee is the Axis Bank, and Axis Bank will make sales of the gold coins to its various customers. If Axis Bank is not able to sell the gold coins to its customer, it may return the gold coins again to the refiner. So this is a consignment arrangement. So for the consignor, once he sells the gold coins, supposing he consigns 10 gold coins to Axis Bank, 10 pieces of gold coins, he cannot recognize that those price of those gold coins are the same. When Axis Bank sells one gold coins to a customer, then at that point of time, sale of one gold coin will be recognized by the consignor. And Axis Bank informs, I have sold one gold coin, then that sale will be recognized in the consignor's book. That is called consignment sale. So the arrangement between the consignor and consignee is that consignor will ship the goods to consignee will hold the goods and try to sell the goods to third parties. Whenever a sale is made by the consignee to a third party, then the consignor will be able to recognize the revenue in its books. If the consignee fails to sell the goods, then they may return the goods to the consignor. So here the goods gets transferred, the title also gets transferred to the consignee, but the risk and rewards of ownership still remains with the consignee, because the goods may be sold or not be sold. Okay, that is what is consignment sale. So have I been able to answer your question, Shiva? So we'll move to the next slide. So we are talking about repurchase agreement, sale and repurchase agreement. So under sale and repurchase agreement, so there is an agreement between the seller and the buyer that at a later point of time, the seller may repurchase the goods he has sold to the buyer. He may repurchase those goods. Or he has a call option, that means he can ask for the goods to be sold back to him. That is what is called sale and repurchase agreement. So in this agreement, revenue will be recognized according to the substance of the transaction. If the substance of the transaction is that the seller has transferred the risk and reward of ownership to the buyer, revenue should be recognized. But if the substance of the transaction is that the seller retains the risk and rewards of ownership, even if the legal title is transferred to the buyer, the transaction is basically a financing agreement and doesn't give rise to the revenue. So sale and repurchase agreement is also used as a financing agreement when particularly the risk and rewards of ownerships are retained by the seller. So you have to look at the substance of the transaction in each case and determine whether revenue should be recognized or not in case of sale and repurchase agreement. I am leaving the slide for you to go through it, and then we can move to the next slide. So sale and repurchase agreement is quite common as a financing agreement. So many times, as you may be knowing, I do not know that you are aware of that. When banks borrow money from RBI, we are aware of a rate called repo rate. I don't know whether some of you may be aware of what is called repo rate. Now repo rate is basically it's an interest rate. So here the sale and repurchase is done between a bank borrowing money from RBI and RBI. So the bank borrowing money sells some securities to RBI with an agreement that they will buy back the securities at a later point of time. Okay, and the difference between the price at which the securities are sold to RBI and the difference of the buyback from the buyback price at which the securities will be bought back by the bank, that constitutes the interest that they pay to the RBI because they are actually borrowing money. This is a financing element. So they are financing, they are taking finance or availing credit facility from RBI, taking loans from RBI for a specific period. So the agreement is that they are selling certain securities for 7 days. They are borrowing money for 7 days. So they are selling the securities at, say, 100 rupees is the selling price, and they will buy back the same securities after 7 days at 101. So the difference of 1 rupee will basically be the interest cost they are paying on the funds of 100 rupees they are borrowing from RBI. So that is called, that rate is determined by what is called repo rate. When banks borrow from RBI under the sale and repurchase agreement, the interest that RBI will charge will be the repo rate interest they will charge. So that is basically a financing agreement. Here the risk and rewards of ownership is not transferred from the bank which is selling the securities to RBI and going to repurchase it after a certain number of days. The risk and reward of ownership is retained by the bank which is selling the security, or which is actually borrowing the money. So that means basically you have to look at the substance of the transaction and understand whether the risk and rewards of ownership is retained by the seller or not. If the risk and rewards of ownership is retained by the seller, even in a sale and repurchase agreement, the revenue should be recognized when the sale is made. But if it is a financing agreement where the risk and rewards of ownership are retained by the seller, then it is not to be recognized as a revenue. The amount that is borrowed from RBI, the 100 rupees will not be recognized as a revenue income. Now we have come to a small exercise. Which one of the following situations signifies that risk and rewards have not been transferred to the buyer? We have a few situations. You have to understand in which situations the risk and rewards have not been transferred to the buyer from the seller. First one is XYZ Incorporated sells goods to ABC Incorporated. In the sales contract there is a clause that seller has an obligation for unsatisfactory performance which is not governed by normal warranty provisions. Normal warranty is, yes, if the equipment or the product is not performing as per the expected standards, the normal warranty requires that the product must be repaired or maybe replaced if necessary. That is normal warranty. But here XYZ is Incorporated is selling goods to ABC Incorporated. In the sales contract, there is a clause that seller has an obligation for unsatisfactory performance. That is not governed by any normal warranty provision. That is something beyond normal warranty provision. So that we will call it as a situation where risk and reverse of ownership have been transferred to the buyer or not? So what is your answer? So what is the response to the first situation? Yes. Do you consider the risk and reverse of ownership have been transferred to the buyer fully in the first situation or not? What do you think? If there is a clause in the contract which says that the buyer has an obligation for unsatisfactory performance which is not governed by a normal warranty provision, then whether the risk and reverse of ownership have been really transferred from the seller to the buyer. So yes or no? Explicit means which is very clearly laid down in the, it's laid down in words. That is explicit. Implicit is which is to be understood. It is not stated but to be understood. Explicit is something which is very clearly written. That is explicit. Explicit and implicit, two words in often used. Explicit means which is very clearly stated. You can see this clause is there in the contract. Implicit it is to be inferred. Something to be inferred from the wording of the contract or something to be inferred from the practice. So Hemant has come up with the answer no, and Hemant, you are correct, because there is a obligation for unsatisfactory performance which is not governed by a normal warranty provision. So the risk and reverse of ownership are still with the seller. It has not been transferred to the buyer on the date of sale. Next question, next situation. XYZ Inc. shift machinery to a destination specified by the buyer. A significant part of the transaction involves installation that has not yet been fulfilled by XYZ. They have already shipped the machinery to the destination specified by the buyer, but a significant part of the transaction involves installation which has not yet been fulfilled by XYZ Inc. So whether you will consider this as a situation where the significant risk and reverse of ownership have been transferred to the buyer. Yes or no? So this time I get two responses to different responses from Shivam. It is yes from Rebates Satyanagar. I do not know your name. You have signed as guest 003. No. Hemant also says no. So I agree with Hemant and my participant from Bhubaneswar Satyanagar. It's no. Because the installation, it is very clearly stated, a significant part of the transaction involves installation. That has not yet been completed. So the risk and reverse of ownership has not been transferred. Unless the machineries are installed, the reverse of ownership doesn't get passed on to the buyer. We cannot use the machinery. So unless the machineries are installed, the reverse of ownership, not only risk and reverse of ownership, both should be transferred from the seller to the buyer. So if the machineries are not installed, will the buyer be able to use the machineries? Till it is installed, it will not be usable for the buyer. So the reverse of ownership that doesn't get transferred. So here also is a situation where the significant risk and reverse of ownership had not been transferred from the seller to the buyer. The last situation. The buyer has the right to cancel the purchase for a reason not specified in the contract of sale, which has been duly signed by both parties. So the buyer has the right to cancel the purchase for a reason which is not, for any reason, which is not specified in the contract of sale, which has been agreed to by both the parties, duly signed by both the parties, and the seller is uncertain about the outcome. So whether the risk and reverse of, significant risk and reverse of ownership have been transferred to the seller, from the seller to the buyer in this situation. Okay, I got one response from Manish. Anybody else? Another response from Shivam, he says, yes. Manish says, no, I agree with Manish. Here also the risk and reverse of ownership will not be transferred to the buyer due to the unspecified uncertainty. So the buyer has the right to cancel the purchase for a reason which is not specified, it is unspecified. So although the goods have been sold, but at any point of time, the buyer can cancel that sale. So seller is uncertain whether the buyer will cancel or not cancel. So the seller still has a risk. So the risk and reverse of ownership has not been really transferred. It is not specified, that's the problem. If it is specified in the contract that he can cancel for this reason and that reason didn't arise, then the seller knows the sale is complete. But since it is not specified in the contract says the buyer has the right to cancel the purchase. That's all. Reasons are not specified. The contract should also specify the reasons or circumstances under which buyer can cancel the sale. But the contract only says the buyer has a right to cancel the sale, purchase at subsequent. So he can cancel for any reason. If he cancels for a reason, okay, the goods are not meeting the specifications, okay, fine. There are certain specifications given in the contract. The quality doesn't meet that specification and things like that. If the reason is specified in the contract and he cancels for that reason, the seller will be certain that whether that reason is there or not. But here the seller doesn't know for which reason the buyer is going to have the right to cancel the purchase. So he can cancel the purchase even after the goods reach the buyer. He can still cancel the purchase, and for any reason. So in that case, we cannot say that this risk and reverse of ownership have been transferred from the seller to the buyer. Okay, so that's why it is no. Now, so far we have been discussing about sale of goods. Now we'll talk about revenue recognition for rendering of services. The revenue is recognized for rendering of services. For sale of goods, we have seen there are 5 conditions to be satisfied. Now for rendering of services, there are 4 conditions to be. For rendering of services, for revenue recognition, there are 4 criteria or 4 conditions must be satisfied. Number 1, the amount of revenue can be measured reliably. It is probable that economic benefits associated with the transaction will be derived. Third is cost to complete can be reliably measured, and the stage of completion can be reliably measured. So when you are a service contracts or service, you are supposing a construction contract, a construction company, they are providing a service. So all these 4 conditions must be met for recognizing revenue. So the revenue is recognized by a reference to the stage of completion of the transaction at the end of the reporting period if the outcome can be estimated reliably. So if there is a construction company which is engaged in construction service and at the end of the reporting period some construction, some contract they are executing and that has not yet been completed. So how they will recognize revenue from that particular contract? It may happen on the reporting date. So L&T Limited is building a flyover. L&T Limited is in construction business, civil construction business. So L&T Limited is building a flyover. They have got a construction contract for building a flyover in a city. Now the construction is going on. Construction is not yet completed and L&T Limited has to close its books on 31st of March. But that particular contract, the work is still going. Now how the revenue is to be recognized for that particular contract? So, it is service they are providing. So the revenue will be recognized by reference to the stage of completion of the transaction. So how much of that construction contract has been completed? Maybe they will refer to that. 50% has been completed or 80% has been completed. They can refer to the stage of completion of the transaction at the end of their reporting period, that is 31st. It will be if it is possible that the amount of revenue can be measured reliably, that means how much revenue they have earned by completing 80% of the contract, it is also probable that economic benefit associated with the transaction will be derived, that they will get paid. Cost to complete can be reliably measured, so how much it will require to complete the contract, and the stage of completion can be reliably measured. So if these conditions are met, all of these have to be fulfilled to categorize as all of these have to be fulfilled. To categorize a transaction as outcome can reliably be estimated, otherwise it will be categorized as outcome not estimated reliably. So if these four conditions are satisfied, then we categorize the transaction as outcome can be reliably estimated. If these are not fulfilled, then we have to categorize this as outcome not estimated reliably. Okay. So the stage of completion of a transaction can be estimated. There are various means of doing it. So depending on the nature of contract, an entity may employ the method that measures reliably the work that is performed. This can include the proportion that cost incurred at the balance sheet date bear to the expected total cost required to complete the contract. Supposing the contract is for 500 crores. The cost to be incurred for completing the contract has been estimated as 500 crores, and already 300 crores have been spent. So 60% of the can be taken as a stage of completion. So this is one method. Or certification or surveys of the work performed. So an engineer can go and he can go survey the work performed and certify how much percentage of the contract has been completed, or completion of the physical proportion of the work. So various methods can be used. In fact, there is a separate, for construction contract, there is a separate standard called IS 11 for construction contract. Okay, which is not be covered in this course, but IFRS 15 also deals with construction contract. That will be taken up in the course subsequently, so we'll have more details there. So when we talk about IFRS 15 subsequently in one of our lessons, we'll see how percentage completion method can be used to determine revenue. Okay, so percentage completion method or stage of completion method basically are one and the same. So we'll have more discussions on this kind of revenue recognition from construction contracts when IFRS 15 is taken up during one of your subsequent lessons. So rendering of service, specific criteria you have to look at. If an outcome is estimated reliably during the rendering of services, the revenue can be recognized by reference to the stage of completion, that is percentage of completion method, when services are performed by an indeterminate number of acts. Recognize revenue on a straight line. So if there are indeterminate number of acts through which services are to be performed, revenue recognition can be done on a straight line method. Where a specific act is much more significant, revenue is recognized when the significant act is executed. The stage of completion is determined maybe by work surveys or service to date of the total service, or cost to cost, that is total cost incurred to the total cost. That will be used for arriving at the stage of completion. If an outcome is not estimated reliably, the revenue is recognized only to the extent of the recoverable expenses incurred. If the outcome is estimated reliably during rendering of service, we can either refer to the stage of completion. If the services are performed by indeterminate number of acts, we will use the straight line method. When the specific act is more significant than others, then we'll recognize the revenue when that particular act gets executed. And stage of completion determination is done by basically either by work surveys for particularly construction contracts, or service to date of total service, or cost to cost, that is cost incurred to total cost. But if the outcome is not estimated reliably, the revenue will be recognized only to the extent of recoverable expenses. So we'll go through this thing in more details when IFRS 15 comes up in a subsequent lesson. Then we'll see some more examples on this particular topic. So we'll look at some only examples at this point of time regarding rendering of services. Like say, installation fees are recognized over the period of installation by reference to the stage of completion. Supposing the service contract, the contract is for installation of plant and equipment or installation of machineries, etc. So here the installation fees will be recognized as revenue over the period of installation by referring to the stage of completion. Last slide, okay. I'll put the last slide. So somebody, Pratibha, wants the last slide. So tell me, Pratibha, when you are done. Then I'll move to the next slide. Okay, thank you. So now I move to the next slide. Now we'll look at some examples of rendering of services. Installation. Supposing the contract, the service to be rendered is for installation of maybe plant or machinery or something. Okay. So installation fees will be recognized. Installation fee is the revenue. How it is to be recognized? It will be recognized over the period of installation by reference to the stage of completion. How much of the installation work has been completed? Subscriptions. Supposing you have subscribed for a magazine. You have paid 12-month subscription. Starting from your 12-month period covers January, December. Now a subscriber has paid 12-month subscription for a magazine, say India Today or something. Now when the seller, that is the India Today, when they are closing the publisher, that is publisher of India Today, when they are closing their books on 31st March, how much revenue they should recognize? So they will recognize on a straight line basis over the subscription period. If 1200 rupees is the subscription, then for 3 months the subscription has been made for January to December. So when March, at the end of March, when publisher is closing its book, how much revenue they should recognize? Only 300 rupees. Because they basically 3 months of subscription period is only elapsed out of 12 months, so 3 months subscription period revenue for 3 months subscription period should be considered as the revenue. Insurance agency commissions. This will be recognized on commencement of the insurance unless the agent is likely to have to provide further services, in which case appropriate portion of the revenue will be deferred. So if an insurance agent is working for an insurance company and they're getting commissions from the insurance company, so when the commission is earned as a revenue, normally it will be recognized when the insurance policy starts. Unless the agent is likely to have to provide further services to the policyholder, in which case appropriate portion of the revenue for the services it will be subsequently given to the policyholder. Appropriate portion of the revenue has to be, we have to only take that a part of the commission as the revenue, and the remaining portion will be for the services to be rendered subsequently to the policyholder, depending on what services are required to be provided subsequently. Fees from development of the customized software. Supposing a company, Infosys gets a contract to develop a customized software for a client. Now the software will be developed by Infosys over a period of time. Now fees from the development of the customized software will be recognized by reference again to the stage of completion, including post-delivery support. So delivery of the software, after the delivery of software, Infosys may have also provide what is called post-delivery support. So fees from development of the software will be recognized by reference to how much of the software has been completed, and you have to take into account also fees will include some post-delivery support. So that portion cannot be recognized as revenue because that will be after delivery. Event admission fees. Supposing some event is taking place and somebody paid admission fee for event. Now the organizer will recognize that the event admission fees when the event occurs. If the event has not taken place, the event admission fee cannot be recognized as revenue. If a subscription to a number of events is sold, supposing you buy a ticket for IPL for several matches. Now, the organizer who is organizing IPL, they will recognize the revenue. Supposing you buy a ticket, season ticket or something for several IPL matches. Now you pay 10,000 rupees for, let's say, 10 matches. 10 matches you are going to see. Now, when the first match takes place, only 1,000 revenue will be recognized. So the total 10,000 will be allocated between the different events, and as and when each event is sold or event takes place, then the fee attached to the event will be recognized as revenue. These are the specific cases of rendering services and corresponding treatment of the timing and extent of revenue to be recognized. Can I move on to the next slide? If you require the slide, you just tell me. So these are some of the examples of rendering of service and how revenue has to be recognized. In advertising commissions. In advertising commissions, there are two kinds of commissions which are paid. One is the media commission. That means the commission that is paid to the media which displays the advertisement. And there is production commission. That means somebody produces the advertisement. You may engage someone to produce the advertisement, like a spot, a TV spot. Now you have to pay to the media commission will be what you pay to the TV channel. And you may ask a producer to produce the TV spot, engaging some people to create a 30-second or 20-second spot. So that is basically the production commission. So for advertising commission, media commission will be recognized as revenue by the concerned channel when the related commercial or advertisement is displayed to the media. Production commission, the producer is producing the advertisement, he will recognize the revenue relating to production commission, referring to the stage of completion of that particular advertisement production. Similarly, financial services, media commission is what you pay when you are displaying an advertisement to a channel, let's say TV channel or newspaper. You have to pay to the newspaper, isn't it? So you are putting up an advertisement in a newspaper, let's say. Now somebody, the advertisement, the piece of the artwork, etc. will be prepared by somebody. That is production commission. You engage some artist to prepare that advertisement you are able to put up. But you have to pay also to the newspaper to print that advertisement in the newspaper. That is media commission. Is that clear, Shivash? When you put up an advertisement in newspaper, let's say, you see so many advertisements coming up in newspaper. Newspaper will not carry it free in there. They will not print it free. They will charge you for the use of that space. So that is media commission. Similarly, when you put up an advertisement in TV, for use of that time, for use of that time during TV transmission, the channel is making transmission, so they are allotting a time, maybe 30 seconds for the advertisement. They will charge you for that time. So that is media commission. Otherwise, how will you reach your audience? You have to take the help of some media to reach your audience. The media could be newspaper, print media, the media could be TV. So you have to use the media, and since you are using the media, you have to pay them the commission, the charges. Is that clear? Shivash? Next, financial services fee. This is treated as an adjustment to the effective interest rate on the financial instrument that is being created. We will be discussing more it in the financial instruments section. So, supposing some financial services fee is charged, the financial service provider charges some fee from the client for providing financial services fee. It will be treated as an adjustment to the effective interest rate on the financial instrument that is being created. So, okay. So it will be more discussed in the financial instrument session which we'll have subsequently. Tuition fees. So you join a coaching center, and you join a course and pay the tuition fee. Tuition fee is normally collected in advance. So for the one semester you pay the tuition fee for a particular course. Now tuition fee will be recognized by the college or the coaching center over the period in which tuition is provided. So if it is a 3-month course, every month 1/3 of the tuition fee will be recognized as revenue. Understand? If it's a 3-month course you are joining and you pay the tuition fee for 3 months, the coaching center or the college or the institution where you are going to take that course, they will recognize it as revenue. Not the entire 3 months tuition fee will be recognized as revenue when you pay. Only after the first month is over, the 1 month fee will be recognized as revenue. Second month is over, another month fee will be recognized as revenue. So basically, it will be recognized over the period in which tuition is provided. Now we look at a small exercise. ABC signed a contract to provide office clearing services. You know, some agencies, they come to the office and clean the office. Okay. So ABC signed a contract to provide office cleaning services to a client for 1 year from 1st of November 2016 for $500 per month. So the contract is for 1 year, 12 months and $500 per month. The contract requires the client to make a single payment to ABC for all the 12 months at the beginning of the contract. So the client pays ABC 6,000, that is for 12 months on 1st of November 2016. What amount of revenue should ABC recognize in its financial statements for the year ended 31st March 2017? The contract is for providing office cleaning services for 12 months starting from 1st of November 2016 at $500 per month, and the full year's contract value is paid by the client to ABC. So how much ABC will recognize as revenue in its financial statements for the year ended 31st March 2017? So I already got an answer, correct answer from Devale Manish. Amount is 2,500 because from 1st November 2016 to 31st March 2017, 5 months are elapsed. The contract is for 12 months. So only 5 months revenue should be recognized for the year ended 31st March 2017. Revenue is at the rupees or at the 500 per month. So 2,500. This is basically what it means by straight line tender. It's a determinate act. Basically the service consists of providing a number of determinate acts. That means office cleaning service for each one. Okay. So if there are a number of determinate acts, we told what we mentioned in the earlier this thing. Next, 3,500 will be treated as the remaining amount will be treated as deferred revenue. So it will be shown in the balance sheet as a deferred revenue or income received in advance. Okay, pre-received income you can call it. It's basically a deferred revenue. Give it whatever name. Pre-received income, income received in advance. The name of the account you can choose, but it's basically in the nature of a deferred revenue. Revenue which you have received in advance, but the service will be provided subsequently. Okay. So it will be a balance sheet. It will be appearing in the balance sheet as a liability. For interest, royalties and dividends, we have talked about revenue recognition criteria for sale of goods. We have discussed the revenue recognition criteria for rendering of services. Now we come to revenue recognition criteria for interest, royalty and dividends. Interest, royalties and dividend recognition criteria. Here the criteria are very simple. The amount of revenue can be measured reliably, that condition must be fulfilled, and it is probable that the economic benefits associated with the transaction will be derived. So only two criteria applies to revenue recognition for interest, royalties or dividend. For interest, royalties and dividend recognition basis will be, interest will be time proportional using the effective interest rate method. Royalties, it will be on an accrual basis in accordance with the substance of the agreement. And dividends, when the shareholder's right to receive the payment is established. Two things. So interest will be on time proportional using the effective interest rate method. So how much time? So if you are closing the books on 31st March, if your reporting period is ending on 31st March, so how much proportional interest is accrued up to 31st March? Okay. Royalty is on an accrual basis in accordance with the substance of the agreement. So basically you have to look at the agreement, understand the substance of the royalty agreement, and it has to be recognized on an accrual basis. And dividends, basically when the shareholder's right to receive the payment is established. Now when a company declares dividend, they also announce the dividend, amount of dividend, and also they will say this is the record date. So if a shareholder sells his shares before the record date, he will not be entitled to the dividend. He will be entitled to dividend only if he is holding the shares till the record date. So the shareholder's right to receive the payment is established when he is holding the shares on which dividends have been declared till the record date. So If the shareholder has already held the shares to the record date, the dividend has been announced, and the record date has been announced, and the shareholder is holding the shares to the record date, he can recognize the revenue because he has a right to receive the payment. Now we'll talk about the difference between IFRS and US GAAP in the matter of recognition of revenue. So in the area of revenue recognition scope, IFRS 18 and IS 11 contains the general guidance for revenue recognition. Here we are discussing IS 18. But there is a lack of specific guidance in relation to industry-specific issues and multiple element elements. So IFRS or IS is not very detailed. It doesn't give industry-specific guidelines. The general guidelines are available, general guidance for revenue recognition available under IS 18 and IS 11, but there is a lack of specific guidance in relation to industry-specific issues. Under US GAAP, which is revenue recognition, is covered under ASC 605. Under US GAAP, there is a large volume of guidance on revenue recognition, including the numerous industry standards. So they have specific industry standards for revenue recognition. So there are a large number of volume of guidance on revenue recognition compared to IFRS, including the numerous industry standards. Second, in the area of revenue from services, IFRS requires that service transactions should be accounted for by reference to the stage of completion of the transaction, that is percentage of completion method. The stage of completion may be determined by a variety of methods, including the cost-to-cost method. The revenue may be recognized on a straight line basis if the services are performed by an indeterminate number of acts over a specified period, and no other method better represents the stage of completion. But under US GAAP, a service revenue should be recognized on a straight line basis unless evidence suggests that the revenue is earned or obligations are fulfilled in different patterns. So US GAAP prohibits the use of cost-to-cost. Cost-to-cost revenue recognition is not allowed in US GAAP for service arrangements unless the contract specifically provides cost-to-cost. If the contract provides, then it will be allowed, but otherwise cost-to-cost method is not allowed under US GAAP. In the area of contingent consideration, that means a consideration which will be paid by the buyer to the seller if a certain contingencies are or certain conditions are made. Okay. Under IFRS, contingent consideration is allowed to be included when allocating total revenue to the components of a transaction. However, facts and circumstances, provided facts and circumstances are not doubtful. But in US GAAP, contingent consideration is not at all recognized until the contingency is resolved. Then we have construction contracts, area of construction contracts. IFRS construction contracts are accounted for using the percentage of completion method if certain criteria are met. Otherwise, revenue recognition is limited to recoverable costs incurred. The completed contract method is not complete. Whereas in case of US GAAP, construction contracts are accounted for using the percentage of completion method if certain criteria are met. Otherwise, the completed contract method is used. Lastly is the next is deferred receipt of receivables. In either IFRS, it is considered to be a financing agreement. The value of the revenue to be recognized is determined by discounting all future receipts using an imputed rate of interest. We have seen examples of that. In case of US GAAP, discounting to present value is required only in limited situations. So we look at a small case study. A Limited has a contract to provide a bundle of business advisory services to B Limited. I think we'll leave it for next session. It will take some time. We will not be able to complete the case study today itself, so we can start with this case study in our next session on Monday. So I will request you to complete your feedbacks today, and then we'll end the session unless you have some specific questions. So please complete your feedback. Case study will take up on our next session. Thanks for completing your feedback. So we'll meet on Monday for our next session.